Right, thank you all for joining us today on our discussion of where to next for Central and East European markets. We'll be taking a look at what's happening globally, how it's trickling down into Central and East European markets. And it's my great pleasure to have here today Dr. Jaka from DM. So let's start off our discussion, taking a look at what's really happening in the global economy in terms of interest rates. If we can get the first slide up.
Oh, we don't have the
Clicker.
What is the clicker? Just one more.
Good, sorry. Great. So, what do you think is happening in terms of interest rates coming through? We're seeing, obviously, this issue of rates having been on hold by the Fed for a number of months. We have it on hold by the ECB. Everyone's expecting or anticipating rates to continue to fall. What do you think will be happening?
It's very important for the market, for the investors, what will happen with interest rates. Yeah, the best example, just look at yesterday what happened in the US after Kashkari said that he put only 2 dots on, so 2 cuts, according to him, there will be only 2 cuts of interest rates in the US, and if the inflation stay elevated, yeah, he's going to recommend that there could be no cuts this year, yeah, and the S&P 500 went down from +1 to -1.5, so 2.5% in a couple of minutes, yeah. That's of course one of the reasons, but it shows how important are the future path of interest rates for investors, yeah, and this soft landing scenario, we can get on this scenario only if Fed will start cutting rates this year, at least 3 cuts, maybe more. But if the inflation is higher and there will be no cuts, it's the risk that could be much more difficult to get to the soft landing. Yeah.
Exactly. So we're looking at potentially a much bumpier course for this year, which will impact equity markets as well as obviously bond markets moving forward. Therefore, one of the interesting things we saw from the last Fed meeting is that they see the neutral rate, which is where interest rates should be once inflation starts to come down. They actually saw it being a little bit higher, 0.10%, which isn't that much. So my question is, do you think that's actually a high enough estimate, given that we may be looking at a very bumpy landing or potentially a no landing scenario where interest rates still remain very high because inflation itself stays quite high?
They just raised the natural rate by 10 basis points, so it's quite a small, let's say, increase, but it shows the trend, yeah, that the rate, we are starting to talk about the high productivity growth, yeah, and the high natural interest rates, yeah, and it's, at the end of the day, it's good for equities and for equity investors, maybe even more for value investors than the growth investors, yeah, because it means that the growth is higher based on the productivity, and there are a couple of reasons why the productivity could be higher in the US, especially last year. I think from the Q2 to Q4, the productivity growth was something like almost 4% on a yearly basis, yeah, so it's quite a rebound. But the risk is that this is only temporary, yeah? And after all, we don't know if this productivity boost will stay with us longer. But if it stays, then it means that there's high growth, and of course, if there's a high growth, then the inflation is less of a problem because we can grow at higher rates, and there's no inflation because the growth is boosted by the productivity, yeah? And there are a couple of reasons why this productivity can be high, yeah? But the risk at the end of the day is this is still temporary, and we need to wait and we'll see.
So if we think that the new neutral rate will be higher, or even should be higher than what they've already said it will be, what do you think the consequences of this are for investor portfolios in terms of their focus on bond duration and or ETFs?
It's good for equities for sure, because there's a high growth and with no impact on inflation. For bond investors and for rates, of course, the yields will be higher for longer. So for those who are counting on on cuts on falling interest rates or long duration right now. That's a bad news, of course, because we are going for higher rates and for longer term. But ultimately, you will get also the higher yield on those portfolios. Yes, on the longer run, you get the higher yields, and it's always, you know, if the growth is higher, the productivity is higher, it's always better for the economy. Yeah, because then we are growing. Then GDP per capita can grow faster, and the prosperity goes up, and so on, so on. So at the end of the day, ultimately, it's good. In the short term, it could be bad for the rates or for the bond investors.
Absolutely. So, given particularly what you've just said about productivity in the US, whether it has been up, it may be a temporary scenario, but given the potentially higher neutral rate, does that hold for the euro area as well, given that its productivity levels have not really grown as much?
Yeah, the situation in Europe is a little bit different. It's not so rosy like in the US, if I can say this way. One of the reasons why the productivity jumped last year is all these large investments in the field of artificial intelligence or related to the Inflation Protection Act, and all these large investments are one of the reasons in the US. Of course, Europe will also have some benefits coming from the artificial intelligence, but this is not on the level like in the US. Yeah, so less of the boost for productivity in Europe. When you look at the labor market, the labor in general is less flexible than in the US. We got in Europe less immigration, so it's also not boosting the growth, GDP potential growth. And in general, the potential growth of GDP is lower. Yeah, so in Europe it's not so straightforward. There will be some boost for the productivity, but not to the extent like in the US.
Okay, so if we're saying that the neutral rate will not be higher in the euro area, we're also looking at the fact that current potential currencies. When we move on to it, I think you've got that on your next slide in terms of we've discussed a little bit of policy rates moving forward. Actually, we can go back to that if you'd like to discuss very briefly the policy rates in Central and Eastern Europe. We've had Bank of Japan obviously cutting rates. The ECB, as I said, has held rates. The Fed, you know, we're looking at this path moving outward and expected cuts coming through beginning in June. For the ECB, the Fed, maybe not at all this year, or even perhaps only around June, July, or later out to this year. What about for Poland? I mean, the big issue obviously is that rates were held yesterday. Headline inflation has been coming down for the past few months, but you have a reason for why they kept rates up, don't you?
In Poland there will be some let's say rebound in the inflation that's in the consensus forecast, and what is priced by the market, as you can see on the chart, is that there will be no, after all, there will be no cuts in Poland. If you look at the Hungary or the Czech Republic, there will be some significant cuts, of interest rates, but not in Poland. It's based on simply on the inflation. I think we cannot afford to cut rates. There will be some rebound in inflation when you look at the VAT on food, and you can also, the energy prices are frozen, and if you let them go to the let's say market levels, that also will boost the headline inflation. So we are not in a position to cut rates, which at the end of the day it's I would say it's marginally positive for Polish equities, because on the Polish Stock Exchange you got a lot of financials, something like 50% of the market is financial.
Banks.
Banks. So higher rates for longer means higher profits for banks, and they are the main engine behind the increases in the Polish Stock Exchange. So it could be positive for these sectors. Ultimately, I think ultimately we'll also cut rates, and Poland is embedded in the European, let's say, economy, global economy. So cutting rates elsewhere also will influence the Polish market, but maybe not this year, but ultimately we are also going to cut rates.
So given the points of cutting rates, the ECB is looking potentially at a June rate cut. That is very much market expectation. What do you think are the implications for the ECB in terms of the currency impact overall, relative to the fact that they will potentially be cutting before the Fed cuts?
Yeah, that's a questions and small questions about the US dollar and what usually at this stage of the cycle when you expect the cuts in the US and the Fed is going to cut rates,
Dollar would be softening.
Dollars should be softening, yeah.
Yeah.
And you can see on the charts that it was in the 2001, 2008, 2007, yeah, and also. Especially in 2007, and we got the very strong commodities, yeah, and the oil price and so on. One can recall, and dollar should be softening, yeah. But this cycle, I think it's a little bit different, and the main reason why it's different is the very strong growth in the U.S. It's so U.S. has the strongest growth. U.S. has the largest problem with the inflation. The rates. Interest rates will stay higher for longer in the US. So at the end of the day, we are in the situation that the rest of the world is going to outdo the Fed. Yeah? So there will be cuts in Europe. That's almost for sure. I think June is almost done. Yeah. But when you look at the US, June is not done. Yeah? It's depending on the data we got. It's 50-50 right now, more or less 50-50 probability that they're going to cut in June. Yeah, so this cycle, dollar is stronger than usual. So I wouldn't expect, I wouldn't put too much chances that we will see, for example, 112 or 115 on euro dollar. It's rather will be neutral, so more or less like is today, with some. Even some, if the inflation will prove more sticky or more embedded in the US, we can even have, let's say, some strengthening in the US dollar. That's my call.
That's a very interesting comment. As you said, where we would expect it to be, and it's actually staying. We're seeing that sticky, particularly wages, but we're also seeing sticky wage inflation within Europe, as well, particularly in the services sector. That's been an issue for the ECB. So. If we don't think that the dollar will weaken, you're saying that you don't think that the dollar will weaken, that it will actually remain quite strong. What does that actually mean? As you said, for the euro is going to therefore depreciate, furthering inflation?
I would say it will be, in my opinion, it's more that more chances to fall for some range bound in terms of euro dollars. Yeah, so like. No particular strengthening on the US dollar side, and no particular weakening as well. So it's different than previous cycles, and with some, let's say, some chance that if the inflation really proves stronger, stickier, and so on, then the dollar will strengthen a little bit against the rest of the world, after all, yeah?
Yeah. But does the US debt situation worry you at all? I mean, we know that debt to GDP, debt to export, we've had the Congressional Budget Office come out saying, it's 97%. We're projecting it much, much higher in future years coming through. Does that affect your view at all?
Yes and no. Yeah, it's of course it's not sustainable in the long run. That's the problem, and almost everybody in the US is showing this point that this is not sustainable. Yeah, but in the short run, if they're not going to increase the budget deficit, right now it's something about 24% of GDP if you count 12-month running, then it's something like 24%. It was about 20 before the pandemic, but on the pandemic or in 2021, on the peak, it was something like 34%. Yeah, it's like during the war.
Yeah.
So if they don't going to jump above 26% of GDP, so there should be no problems with in the short run. So you need to normalize this debt, this budget deficit against the GDP, nominal GDP.
Yeah.
And of course, there's inflation and so on. So nominal GDP is growing quite strong. So those increases in debt, when normalized against the GDP, nominal GDP, are not such a, let's say, huge as, because there are a lot of commentaries and some analysis showing US dollars only. Yeah? The debt is growing by $1 trillion every 100 days and so on. But you need to normalize this against the GDP, because GDP is also growing very fast. So it's in the short run, I don't think there's an issue for investors. Even if you look at the treasury notes and bills auctions, there's some strong demand for US treasuries, because investors are compensated by the yield. Yes, 10 years, 4.4 a couple of days ago. So
it's back up. Yields have surged back up on expectations that the Fed wouldn't be cutting. So you discussed a little bit with regards to the euro, the dollar versus the euro, but what about, say, versus the zloty, or versus other currencies, whether it be the forint or anything else within the Central European Union CE area? Let's say the CE currencies, it depends on the global cycle. I mean, that's the main point which influence the currency. If the global growth continues, then you can expect some strengthening against the euro of let's say CE currencies, including Polish zloty. On top, we've got, of course, the inflation and we know cuts in this year, so it's also a next argument for stronger Polish zloty. And it's also related, I think it's also in the previous cycle, it was strongly related to let's say, commodity prices. Yeah? And recently, a couple of days, we got a stronger oil price. We got it's not only based on the Middle East troubles, yeah, or a higher risk, but also based on the higher PMIs in China and the US, and also boosted a little bit energy prices. So we're seeing more of a demand pull on those markets. Yeah, demand pull on that's important. So it can also put some upward pressure on the CE currencies. But ultimately, I think it depends on the global growth. If the global growth will stop, or there will be some trouble with that, or the investors will simply move to the phase of risk off, then we can see significant weakening of Polish zloty and local currencies. Yeah, but at the later stage of the cycle. Okay, so given where we are in the cycle and what you've discussed about where the dollar is, what will happen potentially to the euro as a result of the ECB policy itself and vis-a-vis Fed policy, what do you think will be the impact on European equity markets? I mean, they're very much, to a certain extent, undervalued relative to the US. We have the Magnificent Seven in the US, which has led the charge, and when we look below that, the other 493 within the S&P 500, they're not haven't performed as well. So we've had questions about concentration risk, questions about the overall breadth within the market there. And European equity markets have actually been performing fairly well, particularly what have been termed the granolas, have done very, very well. Do you think that people should be maybe starting to think more about European markets? I think one of the main story behind the strong equity markets also in the US, Magnificent Seven, and the big tech and big companies is this. I call it Nifty 50 trade. Yeah, so it's this that investors love large caps. Yeah, and in the history, in the 70s, in the 60s, and the 90s, we had a similar trades. And this is quite compelling for large institutional investors to invest in large companies, especially today when the large US companies and also European ones, they got quite big market shares. They are growing much faster than the rest of the S&P 500. Yeah, and they got large piles of cash. They are capturing all these artificial intelligence investments and so on. It's a $3 trillion company. Yeah, and they also operate within the
quasi-monopoly, global monopoly. Yeah? Each of the Magnificent Seven, you can show this is what is the market, what is the global market share of each of the Magnificent Seven. It's almost monopoly. Yeah. So there are reasons why investors love those companies, and I would expect that this trend will continue until the end of the cycle. Yeah. So that was the case in 2000, in the year 2000, in 75, I think 74, 75. Also, we got this very popular Nifty 50 trade, and the top 50 companies outperformed the remaining ones. And investors used to put the, let's say, almost double the valuation in terms of the forward PE, for example, in the 70s, in the 90s also. So they used to pay twice as much in terms of valuation for those large caps. So I would bet, my opinion is that it will continue until the end of the cycle, yeah. And only the major bear market can erase this, let's say, this attachment and this demand for these large caps, yeah. So I would say we're going to have more of this. Of course, the corrections will happen, and the correction on the Magnificent Seven will be a little bit larger than on the rest of the market. It's a mini version kind of the story, yeah. But I would bet, including NVIDIA, that this trend more or less should continue to the end of the cycle.
Okay, given that it's essentially the problem that you discussed is that concentration risk. They take up so much of the market, and if we're looking at a higher rate world, then what are the implications for those smaller companies, for those the mid cap to small cap within that universe?
It's not good for them. When you look at the Russell 2000, yeah, you look at the performance or underperformance of the Russell 2000 against S&P 500, for example. Yeah, it's not only this year, but the previous as well. So they are against the small companies in US in particular. They do not have large piles of cash. Yeah, they are much more exposed to interest rates. Yeah, so it's the market is right in this terms that there is underperformance of small companies, and the only cure is soft landing. Yeah, so or Goldilocks scenario for equities in general. So lowering so interest rate cuts, and that could help the small companies. And if the market would, because right now there's a lot of talk and discussion about the higher for longer inflation risk and so on. But I think the market needs only one data point, for example, I don't know, the inflation in US for April, which we'll get on 10th of May or so. One good point with the, let's say, some 10 basis points, 15 basis points lower inflation that the market expects, and then I think we'll see some, I don't know, even some significant move on the rates, down and so on. And at this point, if this can happen, that's a good point for betting on underperformance of small caps, yeah, because they need lower rates. They need lower rates, soft landing scenario, Goldilocks scenario. Then they can outperform or mean revert the recent underperformance.
What was the next slide? Do you want to go on to quickly, since we've discussed the S&P after the Fed hike a little bit just now. So this was taking a look at what you see as happening potentially after what we've seen after the last Fed hike. So again, if the Fed doesn't cut this year and the ECB cuts, Poland keeps where it is, other banks in Central and Eastern Europe cut, what are we seeing for European equity markets and bond markets versus US markets?
It's at the end of the day, I think in terms of the equities, it's all about the inflation, because no cuts means there's a reason why there are no cuts. Yeah, because the growth is strong enough, and that's really good for the equities, because it means stronger profits, and as you can see, except for 2000, it was the bubble popped in 2000. Yeah, so except for this cycle, the pause of the Fed or hiking the interest rates are generally good for equities because it means that the profits will be higher, so they can grow. But this cycle, the inflation is really could be a problem, and if inflation proves, let's say, temporary, there will be some, let's say, easing of inflation. That will be good for equities, and we can continue the bull market, and until the point when the market will need to decide: are we going for a soft, hard landing, crash landing, or no landing? Yeah, and usually I would say it happens after the couple of cuts of so first, second, the third cut is good for equities, and then there's a point when the markets, like in 2008, for example, yeah, or we need to decide which scenario we are going for.
But then again, we have some rather huge risks this year outside of the inflation story. Then actually it will be, which of course, the known geopolitical risks. And the biggest risk of all is, of course, the US election coming through.
Yeah.
And we've seen the consequences, you know, either we have expansionary, potentially expansionary fiscal policy that we've had under Biden with the Inflation Reduction Act, and of course we had all the activities that during the COVID period, which prompted the rise in inflation in terms of being that demand push consequence after. You know, we're looking at that as a risk. So, or do you see, you know, what do you see happening with that at the European parliamentary elections, given that those may be influenced and will be particularly influenced by the ongoing war in Ukraine? We still have energy transition going on. We still have EU green policies going on. So how do you see these factors feeding into what you're looking at in terms of scenarios for where investors should be or what they need to be thinking about?
It's a quite tall wall of worries, I would say, because you just mentioned a lot of points which are rather risky for the markets. But I would start from the fact that this is simply election year. And you look at the history, investors, economies or economy ask more in such a year. Ask for more. So investors expect more, economy expect more. This is simply election year. So if you look at so I would start from this point, and we need to keep in mind that in the election year everything is better, everything is more rosy, and the growth is higher, everything is better. Of course, there are those risks, and I think everybody will try to postpone them after the election, or at least they will try. I'm rather, let's say, optimistic about the markets until the elections, and then we could have some, even you call it in English, air pockets also, that all of the things were postponed after the elections, and then we can have some air pockets in Q1 next year, for example, yeah, and then also when you look at the interest rates, if right now in the US we've got 5.5, which is quite high in the history, and if the Fed is going to cut once, two, or even three times, it still will be something like 4.75 just after the elections. One can expect some air pockets. You've got for the previous 15 months very high interest rates, which also stress the system. Of course, if Trump wins, then you can expect extra debt issuance, extra tax cuts, and all the policies pro-growth, so about financed by the debt. So it's also, and in the background, you can have a problem with inflation, yeah?
Absolutely.
So I'm not sure, at this stage it's difficult to say what will be the net effect after the election if you combine all these risks, air pockets, higher rates, and so on. It's could be interesting.
Yeah, it's going to continue to be interesting what happens with the US, given that if Trump gets in, he as mentioned, he has, when he was previously president, increased the level of overall debt through the tax cuts, which are due to be ending this year, but if he gets in, then he'll obviously want to extend those tax cuts. That increased the overall debt to GDP ratio, again, going back to earlier points. And if Biden gets in, we're going to see a lot of fiscal promises coming through. And we'll also see this in the EU parliamentary elections, obviously, in terms of parties. So that goes back to the point that bringing us back to Poland, and I know we're ending our time now, in terms of where we see things happening for the future for Polish growth.
Polish growth mainly depends on the global cycle, in terms. So it's like other emerging markets. So we are dependent on the global cycle. That's, I think, is the first point. And if there will be some weakening in the eurozone, and in Germany in particular, we can ultimately feel it as well. But the main engine of global growth, US, is growing, with the full throttle engine. I would say this way. So from this perspective, look at the recent PMIs, and you can add up the China and also some rebound. Japan is going above the potential. Of course, European is slowing down, and Germany is a kind of a problem right now. But at least until elections, there's rather a positive scenario for me in terms of the growth, and there, of course, will be a kind of wall of worries and a lot of risk here and there. But after all, this is an election year, so everything is much better, brighter, much rosier, and so on.
So in short, we're saying a rosier outlook for now, but be cautious.
Yeah, that's a great summary.
Okay, I think we're unfortunately out of time, but thank you very much for that discussion. I hope the audience got something out of that, and has a little think about how it will be affecting their own portfolios. So thank you.
Yeah, thank you very much.